Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Weighted Average Cost of Capital Explained, a complete guide. Understanding WACC, a guide to weighted average cost of capital and why it matters. Every business decision has a cost, and understanding that cost is key to making smarter choices. The weighted average cost of capital, WACC, helps companies measure the cost of funding their operations, whether through debt, equity, or both. Investors also rely on WACC to evaluate potential risks and rewards. In short, it's a fundamental tool for assessing profitability and value. By grasping WACC, you'll gain insights into how businesses make decisions about growth, spending, and investments. What is WACC? When businesses raise money, they often rely on a mix of different funding sources, such as borrowing money, debt, or selling ownership stakes, equity. Each of these sources has a cost, and the weighted average cost of capital, WACC, represents the average cost of all these combined. It's like blending the interest rates on your loans and credit cards to figure out how much borrowing money costs overall. But for businesses, this equation includes both debt and equity funding. Definition of WACC. WACC measures the average rate a company must pay to finance its operations through a mix of debt and equity. Simply put, it's the cost of using other people's money. Calculating WACC involves weighing the costs of each type of funding, debt and equity, based on how much each contributes to the company's total capital. The formula for WACC looks like this. WACC equals EV times RE plus DV times ROAD times 1TC. Here's what those terms mean. E. The total value of equity, stocks issued by the company. D. The total value of debt, loans or bonds issued by the company. V. The combined total of equity and debt, E plus D. RE. The cost of equity, or the return shareholders expect for their investment. ROAD. The cost of debt, or the interest rate the company pays on its borrowings. TC. The corporate tax rate. In short, WACC tells you how much it costs a company to fund its business and is written as a percentage. The lower the WACC, the cheaper it is for the company to finance its growth and operations. Importance of WACC in financial analysis. Why does WACC matter? Because it's one of the most important tools for making financial decisions. Companies, investors, and even analysts use WACC to evaluate whether a project or investment is worth the money. Here's how it's applied. Investment decisions. Imagine a company wants to launch a new product line. If the expected return on the project is higher than the WACC, it's a green light. It means the project will add value. If not, it's probably not worth the risk. In essence, WACC sets the bar for minimum acceptable returns. Business valuation. When valuing a company, WACC is used to discount future cash flows to their present value. This gives investors a clearer picture of how much a business is really worth today. A lower WACC can make future profits look more attractive, while a high WACC can reduce the perceived value. Capital structure decisions. Companies can use WACC to strike the right balance between debt and equity. Debt might seem cheaper thanks to tax benefits on interest, but too much of it can increase financial risk. WACC helps businesses gauge the trade-offs and decide how to structure their funding effectively. Think of WACC as a company's financial heartbeat. It keeps everything running smoothly. It ensures resources are allocated to the most productive areas and helps avoid risky decisions that won't pay off. Whether you're starting a business or investing in one, understanding WACC is key to making sound financial moves. Components of WACC. WACC is built on a foundation of key components that represent the different costs of a company's capital. To fully understand it, it's important to break it down into its parts. These include the cost of equity, cost of debt, and the market values of both equity and debt. Each plays a specific role in calculating WACC and painting a picture of a company's financial health. Cost of equity. Explain how the cost of equity is calculated and its significance. Equity isn't free. Shareholders expect a return for investing in a business, and this expected return is called the cost of equity. It represents the rate a company must earn to justify keeping its investors satisfied. If returns fall short, investors may look elsewhere. The cost of equity is often calculated using the capital asset pricing model, CAPM, RE equals RF plus beta, RF. Here's what that means. RF, the risk-free rate, such as government bond yields. Beta, a measure of a stock's volatility compared to the overall market. The expected market return. This formula reflects the risk-adjusted return investors expect. For instance, higher beta means higher risk, and thus shareholders require a higher return. Cost of equity is significant because it helps businesses evaluate projects or opportunities. It sets a benchmark for profitability. If a project doesn't surpass the cost of equity, it's generally not worth pursuing. Cost of debt. Detail how the cost of debt is determined and its implications. The cost of debt refers to the effective interest rate a business pays on its borrowings. Unlike equity, debt comes with fixed repayment terms, making it a predictable component of WACC. However, interest costs reduce taxable income, which creates an important consideration, the after-tax cost of debt. You can calculate it using this formula. ROD equals interest rate times 1 TC. ROD, cost of debt. TC, corporate tax rate. For example, if a company's loan has a 5% interest rate and a 30% corporate tax rate, the after-tax cost of debt would only be 3.5%. That's because interest payments are tax-deductible, effectively lowering the cost. The cost of debt plays a critical role in WACC. While debt is often less expensive than equity, too much debt increases risk of default. Striking the right balance is essential to keep borrowing affordable but manageable. Market value of equity and debt. Discuss the role of market values in WACC calculation. WACC uses the market value of a company's equity and debt, not the book value. Why? Because market value reflects the true worth of these assets today, based on investor expectations and current market conditions. Using outdated book values could give an inaccurate picture. Market value of equity is straightforward. It's the company's stock price multiplied by the number of shares outstanding. Market value of debt can be trickier, as it's based on the present value of all future payments owed. These values affect the weights in the WACC formula. EV, proportion of equity in total capital. DV, proportion of debt in total capital. The higher the proportion of equity, the more expensive the WACC usually is, because equity typically costs more than debt. Conversely, a higher proportion of debt can lower WACC, up to the point where financial risk outweighs the benefit. For businesses, this balance isn't just a number, it's a strategy that affects everything from risk-taking to shareholder value. Calculating WACC. Understanding how to calculate WACC is crucial for analyzing a company's financial health and decision-making. By using a structured formula and real-world examples, you can see how the pieces fit together to provide this key metric. The WACC formula. Present the formula and explain each component. At its core, the WACC formula combines the costs of equity and debt, weighted by their proportions in the company's capital structure. The formula looks like this. WACC equals EV times RE plus DV times ROD times 1 TC. Here's a breakdown of what each term means. Equity. This is the market value of a company's equity, calculated as the stock price multiplied by the number of shares outstanding. Debt. The total market value of the company's debt, which includes all loans and bonds. Total value. The sum of equity and debt, E plus D. Cost of equity. The return that shareholders expect, often calculated with the capital asset pricing model, CAPM. ROD, cost of debt. The effective interest rate on the company's borrowings, adjusted for taxes. TC, corporate tax rate, the percentage of income a company pays in taxes. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.